afternoon, everyone, and welcome to our webcast on the Ohio Budget Bill for fiscal 2014-2015 and how it will impact you. I'm Staller, tax partner with Battelle & Battelle. Our moderator today and our speaker today will be Brian Schneider, tax principal with our firm. Brian received his bachelor's degree from Wright State and his master's in taxation from the University of Cincinnati. He has 16 years of experience, including 10 years with national firms. Brian's experience includes all aspects of state and local taxation, including income franchise, sales and use, property taxes, incentives and credits. He also has experience dealing with credits and incentives available at the federal level. Before we get into the presentation today, a couple of housekeeping items to mention. First of all, if you are interested in receiving CPE for today's session, you should have received a CPE verification sheet along with your handout materials via email. Stepping in a few times throughout the discussion today with CPE verification questions. Again, like CPE, please listen for those questions, fill a verification sheet, and return it to Lynn Coonley with our firm, and her email address was included. Second thing is we would definitely appreciate any feedback you have on today's presentation. There is a participant evaluation form that was included in your materials. So if you could please complete that and return that to Lynn Coonley as well, we would certainly appreciate it. With that, I will turn it over to Brian for our presentation today.
Thanks, and good afternoon, everyone. Before we start, we'll start with the agenda on what we're going to talk about. And before we jump into the agenda, I just wanted to mention one thing. Hopefully, the title of the presentation does not fool anyone with the language of a budget bill. Just to confirm that this bill has been signed by the governor and it is law. It is not proposed at this time. So the changes that we will be discussing today are effective. There are various effective dates that you'll see throughout the presentation, but the bill has been signed and it will be law, so it's not proposed at this time. So looking at the agenda, we're first going to talk about some of the income tax changes that are in the new budget. Second, we're going to talk about some commercial activity tax or CAT tax changes that were implemented. Third, we'll talk about sales tax and a couple of sales tax changes that went through. And the major item that we'll talk about will be real property tax changes. Then there are a couple of miscellaneous smaller items that we'll mention briefly, not as large as the previous four that we talked about, but some smaller tax changes that are in there as well. We'll also then at the end talk about some of the key items that have changed from the governor's original proposal that he issued, I believe, back in March, compared to what has now been signed into law. And then finally at the end, we will move to a non-Ohio topic on a couple of major state and local tax issues that are popping up at the federal level currently, and how those will impact folks if they get passed at this time. So that's kind of our agenda. Should be a pretty full agenda, and we'll dive into it now as we move forward. So.
The item I failed to mention is that you should have a Q&A screen available to you. So please feel free as we go through the presentation to pose questions, or alternatively, if you want to kind of pencil down those questions and pose at the end, we'll do our best to stop and address any questions we receive throughout the presentation.
Our first topic that we're going to talk about are some of the income tax changes that were in the new budget. This first slide is kind of a summary of those individual items, and then we'll talk in more detail about each one of them specifically on later slides. The first item is the personal income tax rates will be and are currently being reduced by 10% over the next 3 years. The second item is a brand new item, a new tax deduction that is available for pass-through entity owners or small business owners, allowing them to deduct a portion of the income that they have earned in Ohio from their Ohio tax return. The third item is Ohio has put in a new credit. It's a non-refundable credit, similar to the federal earned income credit. So there will be a state earned income credit as well. They have eliminated the current loss that you can take for gambling losses. They've removed that. And then finally, we'll talk about a potential opportunity for individuals who are in a composite return file on behalf of the individual by a pass-through entity as well. A new change that came into play with that. So we'll move to the first topic there, the personal income tax rates. As I mentioned briefly, they're being reduced 10% over 3 years, and this has been the governor's basically number one priority since he took office a few years ago, is reducing income tax rates in the state to make Ohio more competitive, to attract new business and retain business in the state of Ohio. His number one priority is to reduce the income tax rates, and he's been talking about that continuously. I think he still wants to reduce them even further based on what was signed into law today, or back at the end of June. The rates will be phased in begin for 2013, so the current calendar year that we're looking at. Rates will be reduced by 0.5%. So what that means is the current, or I guess the top rate in Ohio for 2012 was about 5.9%. The rates will go down to about 5.421, as you can see on the slides. And then for 2014, an additional 0.5% reduction, getting us to a full percent compared to 2012 rates. And then finally, in 2015, the full 10% reduction will be in place, where the top rate will be 5.33 going forward. This is probably the largest impact for the state. That this is projected to have about a $3.2 billion impact over the 3-year period. A couple items to mention on this. Number one, folks may be thinking, well, when am I going to see this change in my paycheck? That likely probably won't take place until the fall, sometime maybe September. The state needs to update their withholding tables and withholding brackets and get those out to employers who are then, when they receive those, can update the withholding on most folks' paychecks. But in reality, most individuals won't see this change probably until they file their tax returns in 2014. For the most part, that's when they'll see that via refund.
Just observation, Brian led into this slide with some discussion about making Ohio a more attractive place to do business. And just to put this in perspective, I think a lot of times people purely look at corporate income tax rates in terms of fact the company might consider for locating, but attracting and retaining talent is certainly a top priority for most organizations as well, particularly the larger employers. I think there are a couple of states out there, namely New York and California, that have impressed a little bit lately for how high they've gone with personal income tax rates, and it doesn't do a business much good to locate in a jurisdiction if they can't attract and retain top talent. So both what Ohio's done with the commercial activity tax on the corporate side and elimination of the income tax, combined with the direction we're headed with individual tax rates, at least in theory, would make Ohio a more attractive place for companies to do business.
Yeah, that's correct, Justin. A couple other points on that. That kind of is the overall theme that we're seeing in Ohio, as well as other states, where states are trying to move to a more consumption-based tax system versus a tax system that's reliant on income taxes. Because of kind of the uncertainty with income taxes, there's more certainty with consumption-based taxes, like a sales tax, like the commercial activity tax, like a property tax. They're trying to move more toward those and reduce the income taxes, because they see that as a more stable stream of income for the states going forward. The last item I'll mention on that regarding the rate reduction is that does not have any impact on the local or the municipal income tax rates. So those will still be in effect. on top of the state rate, and that's another burden that Ohio faces, trying to be competitive with other states. Is Ohio is one of a few states that do have municipal income taxes. So if you're comparing apples to apples, if you're looking at personal income tax rates in Ohio, you also need to look at the municipal income tax rates that potentially an individual could be subject to, depending on the jurisdiction that they live in. So move to the next slide that talks about the new tax deduction, which we've got titled here, pass-through tax deduction, which we'll talk about may be more than, there may be opportunities for more than just pass-through entities. What this new deduction allows is it allows the owners, so the individuals, this is not an entity-level deduction, it's an individual deduction, it allows them to deduct 1/2 of their income that they derive from a trade or business. That is limited to $125,000 per return, or $62,500 if you file separately, if two spouses file separately. This deduction is effective beginning January 1, 2013, so it's retroactive back to 2013, so it will apply to the current taxable year that we're in currently. And the Department of Taxation has projected that approximately 98% of small businesses should be able to take advantage of this deduction. So they think it's a very wide-ranging deduction. The impact on a particular company will obviously depend on how much income or how profitable they have, or how much profit they have, excuse me. To give you an idea, you see a $125,000 deduction, which seems like a large number, but in tax terms, again, that is a tax deduction. It's not a tax credit, for example. That $125,000 deduction basically would equate to roughly a $6,000 or $7,000 tax savings for individuals. So you have to factor in the tax rate and the tax impact of that as well. Also, other things to mention regarding this deduction, this will reduce a school district tax base that an individual may be subject to if they reside in a school district and they have to file an Ohio school district return. This reduction will also reduce that school district tax base, so there will be some additional savings from that as well. A couple of other items. When we talked about pass-through entities, I think we've said it clearly applies to any type of pass-through entity, so an LLC, an S-Corp, a partnership. A couple other uncertainties that are out there that will probably need to be addressed will be, what if I'm an individual and I have a business and I file it on my Schedule C or an LLC? Would I be able to take advantage of that? It appears based on the statute that individual would, but until we get further guidance, we'll have to wait and see on whether that is applicable to someone that's filing a Schedule C. It also brings the question that if you've got a rental property, for example, on Schedule E, would you be able to deduct that piece of it as well? Again, same with the Schedule C. We think there's a likelihood based on the language in the statute. Until further guidance is listed, we 100% sure on that right now. So,
we'll comment on that. When you think about a pass-through entity, and Brian and I were discussing this before the presentation, a couple of possible fact patterns. We obviously have a number of clients that are owners in either LLCs, taxes, partnerships, or S corporations that are active in the business. The other end of that spectrum would be someone who's an investor in a limited partnership. And frankly, that income looks and feels a little bit more like investment-type income. They're not active in the business. So Brian pointed out, I think there are a number of unanswered questions in terms of how broadly this provision is going to apply. Also, a couple questions have come in here. We've got a question about where the Ohio rate stands in terms of per income tax rates relative to the nation and other surrounding states. I'll give my 2 cents and turn it over to Brian. The individual tax rates vary wildly. Again, I mentioned a couple being New York and California that are upwards of double digits. We've got states that also do not have personal income taxes. Florida is the first one that comes to mind. So I think the answer is that Ohio is probably going to be somewhere in the middle, but at least maybe trending towards perhaps the bottom third. Brian, what are your thoughts on that?
Yeah, I think that's accurate, and I think what Ohio is focused on is not focused nationally, but they're also focused on what Ohio feels is their competitive states, the surrounding states, that they are usually in competition with when a new business is looking to locate in a new facility somewhere. Ohio knows which states they are typically competing against, and more recently those have been some of the southern states, southeastern states. So those are the ones that they're trying to be more competitive with. And one way they feel that they can do that is reducing, obviously, the personal income tax rate, because not only impact the individuals, the employees that will be working for that company, so they feel that that's an attractive option to list for a company looking to locate there. So,
questions. We have a question about whether both Ohio residents and non-residents will be eligible for this deduction. Again, looking at the statute, it's pretty general, and it may frankly come down to the mechanics of the form. I think Brian and I were discussing this very question before the presentation, and presumably if you have business income showing up on your return, regardless of whether you're a resident or non-resident, this would be available. But again, that specific fact pattern has not been outlined in the statute. Yeah,
one comment there that I think has been stated is for a non-resident, if you include it in a Ohio composite return, what we're hearing is you will not be eligible for the deduction. So in order to take advantage of the deduction, you will need to file an individual return, and if included in the composite return, which we'll talk about here in a couple minutes, you will now be able to be included in a composite return and also file an individual return to take advantage of this deduction. So.
Another question we have, it says for the pass-through deduction, is that just wages or wages and distributions? And I think our read on the statute here is that it's gross receipts less expenses that's up in the starting point for the Ohio income tax return. So in other words, if you had a Schedule C, it would be the net income from Schedule C shows up on the front page of the return, assuming that eligible, or it would be the pass-through entity coming through from an S corporation income. It would show up on page 2 first of Schedule E, and then on page 1 of your federal 1040, which leads you to your adjusted gross income, which is a starting point for Ohio tax computation. I think for this slide,
we'll jump into the next topic here, which I mentioned here briefly in the past, was there's now a new election for individuals, investors that are included in a pass-through entity composite return that's filed on behalf of the investors. Currently, prior to the budget bill being enacted, a pass-through entity could elect to file on behalf of all of its investors, which is called a composite return, and the entity pays the tax on behalf of the investors, so that the investors don't need to file individually themselves. Because of that, when you're included in a composite return, the composite return tax is calculated at the highest marginal tax rate. You're not allowed to claim any personal exemption credits, and any business-related credits from the entity are not able to be claimed on the composite return. Now, the new law, effective beginning this calendar year, will permit an individual investor to file an individual return if they are included in a composite return, basically in order to take advantage of some of these benefits that were mentioned above. And one of those obviously being the pass-through entity deduction. So if you're a non-resident investor and you're included in the entity filed a composite return on your behalf, and to take advantage of the pass-through entity deduction that we mentioned on the last slide, as well as some of the tax bracket benefits that are associated with with that, instead of paying the top marginal rate, you would need to file an individual return as well, and you get a credit for the tax that was paid on behalf by the composite return. That has been an issue that a lot of individuals have fought over the last couple of years because Ohio did not allow that. Now they will be allowed to do that going forward for 2013, which is good news for taxpayers. So.
Yeah, for those of you that are not familiar with composite filings, as Brian mentioned, we typically set in a fact pattern where you non-resident shareholders in an entity with an Ohio filing obligation, really just a simplification provision so you don't have to have each and every shareholder that lives out of state come to Ohio and file a personal income tax return reflecting some pass-through entity income. Now it sounds like, Brian, we can effectively do this scenario with each shareholder and figure out would their Ohio tax liability be lower if they went and filed the individual return versus sticking with that composite return that we filed at the entity level.
Yeah, that's correct. Yeah. Yep, that's correct. And still file the composite return and decide whether you wanted to file individually if there was some benefit or not, too. So.
We'll go into the next slide. I did want to jump in with the CPE verification question. Areas that will change under House Bill 59, which is the budget bill, is the treatment of composite tax return filings. So answer to CPE question number 1 is composite return. Again, CPE question number 1, composite return.
All right, now we'll jump into our last, the last slide on some of the income tax changes, and these are just some more of the minor changes that we just wanted to mention. Number 1, the income tax bracket and exemption inflation indexing that was scheduled for 2013 through 2015 has been suspended because of the reduction of the income tax rate. So the exemption amount that is subject to inflation that bumps up each year a little bit will not happen for 2013 through 2015. Also, the 20% personal exempt credit will now be subject to an income limitation. So if you have AGI, your AGI is above $30,000, you will no longer be able to receive that $20,000 credit for each personal exemption. Also, as I mentioned briefly before in earlier slides, there's a new non-refundable earned income tax credit similar to the federal income tax or earned income tax credit, and the state credit will be basically 5% of the federal credit. That will be new as well. And then finally, the last item that I mentioned was the repeal of the income tax deduction for gambling losses. For federal income tax purposes, you can deduct gambling losses to the extent of gambling winnings, and that's shown up as an itemized deduction. Ohio now will no longer permit that gambling loss. Probably has something to do with the new casinos coming into play here in Ohio in the last few years. So, but on the income tax changes.
One kind of editorial comment on this: Ohio has historically avoided the very progressive structure that you see on the federal income tax side in any sort of means testing or income testing. We see that all the time in the federal tax regime. To date, we have not seen it at all in the Ohio tax regime. In other words, if you look at the tax brackets, they're the same for a married couple as they are for single. There's no fade-out saying if you make above a certain amount, you're not going to get one of the deductions in Ohio. Very straightforward. I think the second and third bullet here, and also another topic we're going to talk about here in a few minutes, those are the first 3 areas that I've seen in my years in practice where Ohio sort of seems to be headed down the same path that the federal government has, and that's that higher-income taxpayers not only will pay a higher rate, but also may lose some of the other benefits that are available to lower-income taxpayers, and we certainly see that with the personal exemption credit, which obviously isn't a big number, but perhaps more importantly, kind of mirroring the federal earned income tax credit, which is obviously available for lower-income taxpayers.
We'll move on to some of the commercial activity tax changes, or CAT tax, as a lot of people refer to it. The main change here is basically changing the minimum tax that's associated with the commercial activity tax. Prior to this change, basically every entity was that was subject to the tax that had gross receipts of $150,000 was subject to the $150 minimum tax. So that was the minimum tax that you paid whether you had $2 million of taxable receipts or $200 million of taxable receipts. The change that they have implemented will be to change the amount of minimum tax, excuse me, and that will depend on the total taxable gross receipts of the business. So as you can see on the chart there, if you're less than $1 million, you're still at the 150, but now if you have taxable receipts, so taxable receipts would be Ohio gross receipts, between 1 and 2 million, you're at $800 minimum tax. Between 2 and 4, you're at $2,100, and for greater than 4 million, you're at $2,600 minimum tax. Basically, what this equates to, for example, if you're a taxpayer where you have Ohio taxable gross receipts above $4 million, it equates to about a $2,500 or $2,450 tax increase per year for your minimum tax. These minimums do not change the current tax rate of basically just about 0.25%, 0.26%, that everybody pays on receipts above $1 million. So any receipts above $1 million, you will still be subject to the 2.6% tax rate, and in addition to the new minimum taxes, the minimum taxes that will be applicable going forward. On the next slide, we'll talk about here briefly one possible issue that we've noticed with this new tax change is that most of you may know that when you pay your minimum tax, you're required to pay your minimum tax on May 10th each year. That's when businesses are required to pay the minimum tax. Well, with these new kind of bracketed tax amounts, the question will be, if you're required to pay your tax on May 10th, how do you know what your taxable receipts are going to be for the rest of the year? That's obviously an issue that I think they're going to have to address, because if you're a taxpayer and you fluctuate between $1 and $4 million of taxable receipts, you're not going to know on May 10th whether you need to pay $800, $2,100, $150. So that, I think, is an issue that is going to have to be addressed. A real quick other items on CAT tax changes that aren't on the slides. They created an exemption for agricultural and grain commodities, so those are no longer subject to CAT tax. And also one item that I'm not sure many folks on the line are aware of, but something that's been a pretty hot topic. There's a term or an opportunity for something called qualified distribution centers in Ohio. If an entity has a qualified distribution center, and there are certain terms that define that, it's basically an entity that receives, I think it's $500 million worth of purchases during the year. That entity can apply for a qualified distributor center certificate, which basically they can provide to their vendors, that basically allows their vendors to pay a reduced amount of CAT tax. There used to be a $500,000 penalty associated with that if you failed to comply with it. They have now removed that $500,000 penalty and been a new replacement for that, which is more logical. For 2013, there are only 7 qualified distribution centers that have these certificates in the state, so it's not a very widely applicable opportunity. If you were shipping to one of these centers, you would probably know about it. I think 3 of the 7 are some of the larger pharmaceutical distributors in the state that have warehouses in the state. So just wanted to mention that in case anyone is shipping to those. So.
Just one on the previous slide about the minimum taxes. I think the Kasich administration has been pretty open about their desire to reduce the tax burden on small business. Just interesting that we see a provision to exclude a portion of small business income on hand and reduce pass-through entity shareholders' income tax on the personal side. Could do on that, that's maybe a $6,000 benefit, give or take. Then we look to other provisions in this bill, including the cat tax changes, and we're basically giving back about half of that, maybe $2,500, for a business that has more than $4 million of Ohio source receipts. So it's just a little interesting to see how they are, I guess to some degree, talking out both sides of the coin.
Right. Yeah, and we'll move on to the next slide here, and you'll see another one of those, I guess, tax increases that will offset some of the income tax reductions that we mentioned earlier in the presentation, and that involves sales tax. The major change in sales tax will be the state sales tax rate will be increasing beginning September 1st of this year from its rate of 5.5 up to 5.75. And some of you may be thinking, well, you know, for example, in Montgomery County, I pay 7% tax. Well, how does that relate to the 5.5? Well, the additional 1.5% is the local portion of that that will remain unchanged. So, beginning September 1st, 2013, for example, Montgomery County's full tax rate will go from 7% to 7.25%, to give you an example. So those tax rates will be going up. Some other sales tax changes that were included in the budget bill. Number one was Ohio now will become a full member of the Streamlined Sales Tax Initiative. Currently, they are what's considered an associate member. And this provision, which the governor actually issued an executive order on July 9th, about a week ago, to the tax commissioner to make sure that they become a full member. We'll explain why the importance of that when we talk at the end about the Marketplace Fairness Act. The reason Ohio is currently not a full member of the Streamlined Sales Tax Initiative is because of one of the provisions in the Streamlined Sales Tax Initiative used to be destination sourcing for interstate sales. Ohio has always been origin-based sourcing. So the example there is if I live in Warren County and I go into Montgomery County to buy an item at the store, that store is going to charge me the Montgomery County rate. That's the origin or the place where I purchased the item. If it was destination-based, then that store would likely ask me what the zip code. They would put that in, and then they would charge sales tax on the zip code, basically where you would live or where you would be using that, where the product would be the destination of the product. And then the last item we wanted to mention will be sales and use tax on electronically transferred digital audio and audio works and digital books will now become effective January 1st, 2014. This doesn't seem like a big issue, but I think it will be, depending on the definition of those items that I just mentioned. To give some examples of what specified digital products would be. For example, if a company goes out and hires someone to create digital artwork or digital graphic that they're going to use in their business for a flyer, for a brochure, on their web page, for example, the question is that now subject to tax? Is that service, that creation of that digital product, subject to tax? So there'll be a lot of, I think, uncertainty depending on the definition of those items now, because there are a lot more digital products out in the world than there used to be. So going to the slide, October 1st, 2013, cable service and programming will be considered a digital product, so that will be exempt going forward. And also magazine subscriptions. There's currently an exemption for that. That exemption will go away, so magazine subscriptions will be subject to tax January 1st, 2014. We can move on to real property tax. We'll move on to some of the real property tax changes. The first one being a discussion on property tax rollback limitations. Currently, most individuals, and again, this relates to personal or individual type taxpayers, does not relate to businesses. Right now, there's a 12.5% reduction in the value, or they call it a rollback, that individuals do not pay or that they receive on their real property tax. Basically, what happens is the state pays that 12.5% to the local jurisdictions. The law change that will come into play is the state is no longer going to pay that 12.5% on any new or replacement levies that come into play basically after the bill becomes effective. So basically, it applies to any new levies that will hit the ballot probably in November of the year. That 12.5% burden will now fall back on the homeowner or the taxpayer. The state will no longer be funding that for any new or replacement levies. However, existing or renewal levies will still be eligible for that 12.5% deduction. So that'll have an impact. This is, again, another potential tax increase for taxpayers, as Justin mentioned previously about the income tax reductions, but we're seeing now increases in activity tax, sales tax, and now real property tax as well. So, and the final real property tax change that we'll talk about is something called the homestead exemption. This is currently an exemption that up to seniors or disabled, so anyone that is at least 65 years old or disabled, they're eligible to receive an exemption basically on their real property tax that provides up to a 25% reduction in the value of their property. So, for example, if someone that's age 70 applies for this, a house is valued at $100,000. Instead of paying tax at $100,000, they only have to pay tax at $75,000 on the value at $75,000 under this new provision. Provision will do, it's not going to eliminate the homestead exemption completely. It's going to put in this means testing, as Justin mentioned earlier. So now, if you turn 65 or become disabled after January 1st of 2014, you will be subject to this new income limitation. So if your income is above $30,000, you will no longer be eligible for the homestead exemption. If you are below $30,000, then you still are eligible. It's important to note that any folks that are currently receiving this deduction, so they're currently 65 years old or older or disabled, will kind of be grandfathered in and will be continue to receive the benefit. This kind of income limitation will only apply to new folks that will become eligible for this beginning January 1st of 2014.
Just jump in with CPE verification question number 2. House Bill 9 has several changes in the real property tax area. The answer to CPE verification question number 2 is property tax. Again, property tax.
Already talked about some of the major tax changes. Real briefly, we'll just talk about a few other kind of minor tax changes depending on the industry that you're in, obviously. Number 1 is effective July 1st of 2014, the sale of motor fuel will no longer be subject to the commercial activity tax. Instead, they will be subject to a new excise tax on motor fuels that's listed at 0.25% of gross receipts. That's based on the supplier's first sale of that. The reason for this change relates to a court case that was decided over the last couple of years called the Beaver Excavating case, where basically they were challenging whether the CAT tax applied to the sale of motor fuel. They were challenging whether the receipts from those could go to general revenue fund, which is where CAT receipts currently go to. There's a requirement that the revenue from the sale of motor fuel should go to highway construction, that type. So that's what this law, that's the reason for this change, is to kind of segregate the tax on motor fuel so they can allocate that tax specifically to away from the general revenue fund and to other items. So and the last little item that we wanted to mention was a change in the cigar tax. Little cigars will now be subject to tax in the same manner that cigarettes are, effective January 1, 2014. So
if you like Swisher Sweets, get ready for a price increase.
And probably the last item that I think we're going to talk about here on Ohio are just some of the items that were removed from the governor's original budget and how impactful those were, and that they're not in the new budget. The big one is the first bullet on there was in the governor's original budget. A lot of folks probably remember this. There was a proposal to expand the sales tax to basically all services and transactions involving intangible property. In Ohio, tangible personal property is subject to tax, and certain services, if they specifically enumerated in the statute, are subject to tax. So the general rule is most services are exempt unless they're specifically enumerated in the statute. That the provision in the governor's budget would have subjected all services to tax. That has obviously been removed and is not in the budget. Also, an important factor in the governor's original budget, he had a reduction of the state sales tax rate of 0.5%, and you compare that to now in the final version, the sales tax rate is increasing by 0.25%. So the reduction of the sales tax rate that he had in his original budget was going to be offset from a couple of other revenue-generating items, specifically the one I just mentioned of tax subjecting services to sales tax. So not in the new budget, they were not able to reduce the state sales tax rate. They actually now had to increase it. And the last major item that was discussed in the governor's budget was increasing what's called the severance tax, basically on oil and gas and all the fracking and horizontal drilling that's occurring over in the eastern portion of the state of Ohio. The governor wanted to increase the tax on that to capture the revenue associated with those new activities, and hopefully then reduce some of the income tax rates, but obviously it did not get implemented. So you can compare the governor's original proposal. He only wanted to reduce income tax rates 20%. Now he was only able to reduce them 10%, as you can see in the final bill. And another item to mention is that the pass-through entity tax deduction that we talked about, where you can get a $125,000 deduction now. In the original proposal, that was set to be $375,000 deduction. So that new legislation took a dramatic change from the governor's original proposal as well. So,
comments on this slide. First of all, I think we as a profession were certainly concerned to some degree about sales tax being imposed on accounting services, as were our clients. But accounting services, legal services, marketing services, and those types of items being the sales tax, that has gone away with these changes. The other item that Brian did not mention here that's somewhat related had stricken the intercompany exemption provision in the original bill. So in the case we had a client with several subsidiaries and maybe some intercompany charges for corporate office function or administrative services, the original bill was actually going to levy sales tax on those intercompany transactions. Correct, Brian, that all those intercompany concerns have gone away as well?
Yes, yeah, those are all not an issue anymore. So, all right, I think that kind of concludes our discussion on Ohio tax changes. Now, real briefly, before we wrap up, we're going to talk about a couple of significant state and local tax potential changes that are out there. Again, these topics are not signed and are not effective. These are still bills at this time, proposed legislation, but we wanted to raise them again and provide an update because of how impactful they potentially could be to businesses out there. The first one that we wanted to mention is something called the Marketplace Fairness Act. A lot of folks have probably
Brian, get into this. One of the things I want to point out for everybody on the line, When I originally saw this concept, I was thinking it related to companies that sold via internet. Can you just give some examples for listeners in terms of what types of companies or patterns should be concerned with this legislation?
Yeah. In the press, when this legislation actually passed the Senate back in May, it was in the press a lot, and a lot of people refer to it as the internet tax or the online tax. Mainly dealing with like an Amazon.com when they sell products online, whether they should be charging sales tax. The language in this bill does not refer to internet or online tax. It refers to what they call remote sales. And they define remote sales as basically a sale to a particular state where that state does not have jurisdiction to subject you to tax. So basically what that means, for example, a manufacturer, for example, if they receive an order from a customer and the order is to manufacture the product and ship it to multiple distribution centers across the U.S. And then so if the manufacturer does not have a nexus in the states where those distribution centers are located, they would have to charge sales tax. That would be considered a remote sale, even though the customer didn't order the product online or over the internet. Those would be considered remote sales and potentially then be subject to sales tax under the new Marketplace Fairness Act. So that's the distinguishing factor. It's not really just the internet unless they incorporate changes in the House, which we'll talk about. But just briefly on the bill, again, what the bill would require is it will allow states the authority to require remote sellers to collect sales and use tax on all remote sales. The Senate back in May by a pretty overwhelming vote, so there was a lot of support for it. In the Senate bill, there was something called the small seller exemption. So if you have total annual nationwide remote sales of less than $1 million, you would not be subject, and that's based on the prior calendar year, you would not be subject to the Marketplace Fairness Act or the sales tax collection responsibility. And again, that's total annual sales. That's not just in any specific state. So the other thing that the Marketplace Fairness Act mentioned was that remote sellers that would be subject to that the states would have to provide free software to allow the businesses to go ahead and collect the sales tax in all these states and remit the tax and file their returns. So we'll move on to the next slide to give a quick update on what's happened since May. As I mentioned, it passed the Senate back in May, now in the House. And again, this is not an Ohio issue. This is at the U.S. Senate and the U.S. House. That this would apply across all states. The House currently deliberating the bill. One of the discussion topics that they talked about is raising that $1 million small seller exemption up to $10 million, which I know is welcome by a lot of small businesses. The one thing that's been mentioned is there is not a lot of interest or support for this bill in the House as there was in the Senate. Specifically, there are some attorney generals from a couple states who have questioned whether this is constitutional or not, whether they can do it. Another factor to consider is, the states probably all want this because they know that it's obviously going to be an increase in revenue for them. The question will be will they be able to handle the administrative burden of all these new sales tax filings that would be flowing in if this law passes? I know the Small Business Coalition has opposed this, and there's a lot of opposition out there. President Obama in the past has said he will support the legislation if it comes to him. So a lot of this depends on what will take place in the House. It's likely that nothing will take place probably until the fall, because I think they're on recess in August here, with July almost being over. So the earliest I think we would hear something would be the fall of this year. And one last point to mention on this item is I mentioned previously that the states would be required to provide free software to businesses to help them with the administrative costs of dealing with this. Well, what does free software software include? Does it include the integration of that software to, your system, to the setup time, the maintenance, software maintenance costs and all that? Likely that wouldn't be included, so that's going to be an additional cost that the taxpayers will have to have. Just the cost of the software may be free, but the ongoing maintenance and everything may still be a cost the taxpayers would have to
Yes, and I think our clients see other issues, even frankly just registering in the states for sales tax purposes, the volume of notices that tends to generate, looking through their entire product and service offering and determining a taxability of each one of those, collecting, maintaining exemption certificates. All those aspects of this are, I think, kind of have been overlooked when they talk about this legislation and how they think free software is going to make life much easier for our clients.
Yeah, and the last item I'll mention on that, Justin, which I failed to mention, I mentioned it in some of the Ohio sales tax changes when I mentioned Ohio was becoming a full member of the streamlined sales tax. One of the requirements under the Marketplace Fairness Act that is if you're a full member of the streamlined sales tax, then you automatically have authority to start charging requiring remote sellers to collect tax. If you're not a full member of streamlined sales tax, then you have to go through a bunch of simplification requirements to make sure that you are now in compliance with Streamline in order to collect this. So that's why Ohio and a lot of other states are now trying to become full members of Streamline Sales Tax because they envisioning this law passing, and when it does, they want to be ready to start collecting the sales from remote sellers. They don't want to have to go through the process after the fact, so they want to be ready. The last slide that we want to talk about, another major state issue out there is something called the Mobile Workforce Act, or State Income Tax Simplification. Basically, what this proposed legislation would do would require a 30-day threshold before a state can tax a non-resident employee that is visiting that state. So basically, if you have folks that travel to do their job, they would need to be in a particular state 30 days or more before the state could to require them to withhold tax in that, or they require the employer to withhold tax, or for the individual to file a return in that state. Currently, there is no threshold number of days out there. It's kind of all over the board. What we've seen specifically, like in New York has been very aggressive with business traveling to New York for meetings. Even if they're in there one day, New York is trying to assess tax and a withholding requirement on the individual just for that one day. So this legislation would hopefully simplify it across all states by putting in this 30-day requirement. This is to be seen. This bill does have a lot of support. It could be included in a bill with the Marketplace Fairness Act. It could be separate, but again, likely no action on this until probably after the August recess when Congress is back in place. So,
with that, then, with the final CPE verification question before we wrap up. One of the issues that many employers are struggling with is the taxation and related administrative burdens of mobile employees. So the CPE verification question number 3 is mobile employees. Again, mobile employees. With that, I think we wrap up our presentation for the day. We do not currently have any questions in the queue, but if you had one that you weren't able to type in or think of one later, feel free to shoot Brian an email. He'd be happy to talk to you about those questions. And housekeeping, if you do want CPE for this session, please fill out the verification form and either scan or fax that back to us. And also, we'd certainly appreciate your feedback via the evaluation form. With that, we conclude the presentation, and we appreciate your attendance. Thank you.